2022 has been quite an interesting year. I remember back when the pandemic first arose back in 2020, and it was funny. At the start of that year, we just had the US go through their first trade deal with China, and indeed Brexit had been completed. It really did look like it would be clear sailing for the rest of the year, right up until the US presidential elections in November. Now, of course, what we know is by the end of February, the pandemic was very real and was impacting markets and economies globally. And we went through those periods of lockdowns. 2022, it's almost the inverse of that, in the sense that, in most developed countries, the majority of your COVID controls had been taken away. Here in Australia, we sort of very much came out of the pandemic and opened up as an economy. And I guess, someone from the outside might have expected that to be universally good for economies. But unfortunately, what that was combined with was the ongoing sort of supply constraints, largely out of China, where they're sticking to, or have been sticking to, a zero tolerance approach to dealing with COVID. And then add to that the Russian invasion of Ukraine, and that sort of combination of factors, when combined with the stimulatory type actions that central banks and fiscal authorities took in the face of the pandemic, sort of created a bit of a perfect storm for inflation. And so that sort of really brought about an environment where the monetary environment needed to be tightened. But by increasing interest rates, there is an almost mechanical effect on valuations of assets. So, whilst over previous years we've enjoyed the tailwind of lower interest rates really sort of benefiting financial assets, this year that's been turned on its head. And not only has it been turned on its head, but the environment has been tightened quite dramatically. And so that's meant that we've seen quite a lot of volatility. There's been some reasonable amount of dispersion within financial markets as well. We've seen certain sectors do particularly well. Certainly, energy has been a true beneficiary this year. Whether you look locally here in Australia or globally, the energy sector has appreciated by about 50%. And when you compare that to other sectors such as, technology, which are down, as much as about 26, 27% year to date, you can see there's been a real spread of fortunes as to how that's happened. And we largely think that's likely to continue. It is the case that we are adjusting from a long, stable period. It might not have felt stable at the time, but it has been relatively stable. Central banks have had the ability to support markets and support economies largely by lower interest rates. But that period's ended. They no longer have that luxury, and that's because of inflation. And so that sort of environment has meant that we're seeing adjustment at multiple levels in the economy. We're seeing consumers, that their ability to spend has been reduced as a result of higher interest costs because of inflation, particularly those household energy bills. Companies are dealing with similar constraints. Their interest costs have gone up, and they're also dealing with higher input costs. And then at a market level, different asset classes are showing different appeals again. When you're seeing, good quality government bonds trading at around 4% yields, that sort of reverses the trend that we've seen over the past few years, where it's very hard to justify investing in those sorts of assets because the return profile was just so low. It's really hard to know with certainty, where inflation goes from here. I think what we do know is some of the sort of softer parts of inflation have already started to roll over, i.e. come down. And by that I mean, the global supply chains, we've already seen that improve quite dramatically. So shipping costs have come down. All those sort of things that fed into the inflationary pressure on the supply side initially has now started to ebb away. It's got some way to go, but the encouraging signs are there. Equally, energy costs have also been an issue with inflation, and they've started to come back as well. You know, we actually saw energy prices peak in March, so not long after Russia went into Ukraine, and that too has sort of ebbed away to where it is today. So, you know, those factors, those components of inflation have receded, and that's quite encouraging. I think, you know, when we look at the commentary by central banks, the main fear at the moment is that around wages. We all know the sort of statistics. Unemployment is at or near, you know, all-time lows. And, you know, there's a lot of companies out there looking to hire who just can't find staff. And that itself can have a problem from an inflationary point of view, partly because it's very hard to change the supply of labour. If you read between the lines of what some of the central banks are saying, they largely expect unemployment to go up before this element is solved. So, you know, at the moment, from where we stand today, it seems reasonable that inflation in the calendar year of 2023 will likely be tamed. Now, that doesn't necessarily mean that it's brought back into the ranges that central banks want, you know, that sort of 2 to 3% range, but it'll certainly be heading back towards that. And that's just because the central bankers have made it clear that they will do whatever it takes to address this issue. So we do think that inflation will come down. The exact path and the exact timing is very hard to know. But what we do know is things are moving in the right direction. And it's going to be a real keen balancing act as central banks try to deal with inflation, but not drive the economy over a cliff in an attempt to do so. In terms of, you know, central bank activity and the overall tightening cycle, you know, we've gone from 0.1% earlier this year to 3.1%. If you pay attention to the way these organisations are talking, they've all been seeking to front load the interest rate increases, and that's because studies show that if you get that hard part out of the way first, then you've got a much higher chance of a soft landing when it comes to a recession. So what they're really trying to do is, you know, get all the hard work done up front, and then seek to, you know, have more control and more flexibility as they move forward. And so we've already seen here locally that, you know, the pace of interest rate increases has reduced. We've gone from 0.5% increases to 0.25% increases. I think what we'll see as we go into 2023 is we might not necessarily get an increase every meeting as we have done for the last 8 meetings. I think it's probably more likely, you know, going back to that comment of being data dependent, that they'll look to increase rates, but only where they have to, because, you know, the key point here is the natural rate of interest rates, that sort of tipping point between, you know, reining in an economy or stimulating an economy. It's not entirely clear where that is. And so what we'll see as that we move forward is a little bit more of increase, you know, see what happens to inflation, and really try and make the judgments, you know, as the data comes in. It's very hard to know precisely what will happen and when. What we do know is the sort of framework or conditions that it will happen within. And so what we're definitely expecting to see is, you know, that continued heightened level of volatility in financial assets. And that's because, you know, when we think about what's really driven asset prices throughout the year, has largely been, you know, inflation expectations, and therefore the expected impact on interest rates, which therefore translates into asset prices. And so we expect that focus to continue going into the next year. You know, it's a matter of central banks solving that problem. So, you know, heightened volatility is an almost certainty. And then there's going to be, you know, adjustments throughout the economy. There's going to be certain organizations that, you know, can't survive under heightened interest costs. There's going to be, you know, some pressure on consumers as well. And so it is probably one of those environments where we will see some false dawns, you know, that there'll be periods where it feels like, you know, we're out of the worst, that you know, we're moving forward from an economic point of view. And then there'll be some setbacks. And I think, if we can anticipate that, or not anticipate the actual, when and where they occur, but anticipate that we will be wrong-footed a couple of times throughout the year, and not to over-extrapolate any small trend into a long-term trend, then I think we'll be well placed. One of the key factors in investing is dealing with uncertainty. And these points, such as we have now, which is sort of a once in a decade type environment, is a real time of adjustment. And so those adjustments, as they go through, you'll see those different outcomes in markets. And from our point of view, what we're really looking to do is try and see through that noise, and not sort of act on any one small data point, but really try and lean into those longer term trends.